Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Amylyx Pharmaceuticals Inc. annual report. Amylyx Pharmaceuticals is a clinical-stage pharmaceutical company that specializes in the discovery and development of treatment options for neurodegenerative diseases and endocrine conditions. The company's lead products include avexitide, an investigational GLP-1 receptor antagonist, which is being tested to treat post-bariatric hypoglycemia and congenital hyperinsulinism. In addition to avexitide, Amylyx Pharmaceuticals is also developing several other treatments, including Amylyx, a combination of sodium phenylbutyrate and taurursodiol, which is being tested for the treatment of Wolfram syndrome and progressive supranuclear palsy. The company is also working on Amylyx, an investigational treatment for amyotrophic lateral sclerosis. Furthermore, Amylyx Pharmaceuticals has a long-acting GLP-1 receptor antagonist in development to treat post-bariatric hypoglycemia and other rare diseases. Overall, the company's pipeline includes treatments for various conditions, including neurodegenerative diseases such as ALS, PSP, and Wolfram syndrome, as well as endocrine conditions like congenital hyperinsulinism and post-bariatric hypoglycemia. The list of businesses and services provided by Amylyx Pharmaceuticals include discovery and development of treatment options for neurodegenerative diseases, development of treatments for endocrine conditions, clinical trials for various products, including avexitide, Amylyx, and Amylyx research and development of long-acting GLP-1 receptor antagonists. Amylyx Pharmaceuticals Inc. stock price skyrockets. A year of breakthroughs and optimism in the past year, Amylyx Pharmaceuticals Inc.'s stock price has experienced a remarkable surge, leaving investors and analysts alike wondering what's behind this sudden upward trend. One key factor contributing to this growth is the company's innovative approach to treating neurodegenerative diseases. Amylyx's flagship product, Amylyx, has shown promising results in clinical trials for ALS, amyotrophic lateral sclerosis, and Alzheimer's disease. The treatment's unique mechanism of action, which targets both the underlying cause and symptoms of these conditions, has generated significant interest among medical professionals and patients alike. The company's commitment to advancing research and development has also played a crucial role in its stock price increase. Amylyx has invested heavily in expanding its pipeline, exploring new indications for existing treatments, and collaborating with leading researchers in the field. Furthermore, the growing recognition of neurodegenerative diseases as a major public health concern has created a favorable environment for companies like Amylyx to thrive. As awareness and understanding of these conditions continue to grow, investors are increasingly looking to support innovative solutions that can make a meaningful difference in patients' lives. The combination of groundbreaking research, promising clinical trial results, and a growing demand for effective treatments have all contributed to the significant increase in Amylyx Pharmaceuticals Inc.'s stock price over the past year. As the company continues to push the boundaries of what's possible in neurodegenerative disease treatment, investors are likely to remain optimistic about its future prospects. Amylyx Pharmaceuticals Inc. market capitalization of $2 billion is materially smaller than most of its industry peers of roughly $2 billion. Amylyx Pharmaceuticals Inc. trades at a higher price-to-book ratio of 5.42 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The balance sheet appears very conservative, with liabilities representing only 15% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline can be identified through a thorough examination of various financial reports and summaries. According to the provided notes and summaries, several key factors contribute to changes in revenue. One significant driver is product revenue, net, which fluctuates based on sales performance and market demand. Additionally, marketable securities and property and equipment, net, also impact revenue growth or decline as they can generate interest income or be sold for a profit. The Eiger asset acquisition and Gubra/S collaboration and license agreement in 2024 are notable events that may have influenced revenue. However, the most critical drivers of revenue growth or decline are often found within the company's operational performance. This includes direct research and development expenses by program, personnel-related research and development expenses, selling, general and administrative expenses, and restructuring expenses. These costs can either increase or decrease depending on the company's strategic decisions and market conditions. In conclusion, a comprehensive analysis of financial reports and summaries reveals that revenue growth or decline is primarily driven by product sales performance, operational efficiency, and strategic investments. Net income and profit margins. A changing landscape, the net income of the company has undergone significant changes over the years. Initially, there was no mention of any change on page 24. However, by page 32, it became clear that the company had accumulated a deficit of $751.4 million as of December 31, 2025. This negative trend continued with net income expected to be negatively affected by reduced demand for certain pharmaceutical products and additional pricing pressures. The profit margins also experienced a decline due to increased competition from generic products and downward pressure on healthcare costs. By page 32, it was expected that the low profit margins would persist due to significant expenses for research and development. The trend continued with profit margins expected to decrease due to potential price controls and cost containment measures. A common thread throughout these changes is the impact of external factors such as increased competition, reduced demand, and regulatory pressures. These factors have contributed to a decline in both net income and profit margins. Furthermore, the company's inability to integrate acquired product lines, loss of key employees and customers, and adverse impact on profitability from expanded operations not meeting projections have also played a significant role. The data suggests that the company is facing significant challenges in maintaining its financial health. The decrease in net cash used in operating activities by $44.3 million, 26% decrease, from 2024 to 2025, implies a negative net income change. This trend is likely to continue unless the company can adapt to these changing market conditions and regulatory pressures. The financial performance of a company can be gauged by its ability to generate positive operating cash flow. However, based on the extracted summaries, it appears that this company is struggling with negative operating cash flow. According to the data provided, during the year ended December 31, 2025, operating activities used $123.3 million of cash. This significant outflow was primarily due to a net loss of $144.7 million. Furthermore, in both 2024 and 2025, operating activities have consistently used more cash than they have provided. The only positive note is the net cash provided by investing activities, which was $75.7 million in 2024 and $14 million in 2025. However, this alone cannot offset the negative impact of the company's operating activities on its overall cash flow. Therefore, it can be concluded that the company is not generating positive operating cash flow. The performance of various segments and regions has been a significant concern for companies operating globally. In terms of regional performance, the United States, U.S., appears to be one of the few bright spots. The U.S. market is characterized by a uniform policy of coverage and reimbursement among third-party payers, which could potentially mitigate some risks. On the other hand, international markets have been performing poorly due to extensive governmental price controls, market regulations, and cost containment initiatives in countries such as Canada and those within the European Union, EU. These measures have resulted in varying pricing and reimbursement schemes across different countries, making it challenging for companies to navigate these complex regulatory environments. The financial performance of companies has also been impacted by regional differences. In 2024, revenue was reported at $87.4 million, while cost of sales stood at $124.6 million. However, no product revenue or cost of sales were reported in 2025, indicating a significant decline in financial performance. The poor performance in international markets has likely contributed to this decline, highlighting the need for companies to adapt to regional differences and regulatory requirements to remain competitive. Management is optimistic about the company's outlook, citing a strong pipeline of product candidates that have the potential to make a significant impact in endocrine conditions and neurodegenerative diseases. However, they acknowledge that significant additional capital will be needed to continue operations, with existing cash sufficient to fund operations into 2028. The company's financial projections indicate an increase in research and development expenses due to ongoing clinical trials and product development efforts. General and administrative expenses are also expected to rise as the company advances its clinical pipeline. Management is aware of the risks associated with clinical development, regulatory changes, and cybersecurity threats, but remains confident in the company's ability to navigate these challenges. Overall, management's strategy appears to be focused on advancing its clinical pipeline while managing costs and securing additional funding to support continued growth and development. The company has made several significant acquisitions and divestitures in recent years. Acquisitions have been a key part of the company's growth strategy, with two notable deals being the Eiger asset acquisition for $35.1 million and the Gubera/S collaboration and license agreement worth up to $53.5 million. The former involved acquiring substantially all assets related to avexitide from Eiger Pharmaceuticals Inc., while the latter is a collaboration for developing a novel, long-acting GLP-1 receptor antagonist. On the other hand, the company has also made several divestitures, which involve exiting certain products or markets. This includes ceasing marketing and selling of a previous commercial product in the US and Canada, as well as voluntarily discontinuing marketing authorizations for RELYVRIO/ALBRIOZA for ALS. Additionally, the company removed these products from the market in the US and Canada, and also withdrew RELYVRIO and ALBRIOZA from the market altogether. The company's financial history reveals a notable trend. One significant aspect is its dividend policy, which has been consistent in not paying dividends to shareholders. This decision suggests that the company prefers to reinvest its earnings into growth opportunities rather than distributing them as returns to investors. Furthermore, an examination of the company's share buyback activities shows that it has not engaged in any such practices. The absence of mention on this matter implies a deliberate choice by the management to allocate resources towards other priorities, possibly focusing on expansion and innovation. Concerns about inventory buildup or supply chain disruption are evident in several areas. One major concern is the potential for product damage or loss due to cold chain logistics and specialized shipping containers, page 45. Additionally, performance failure on the part of distributors could delay clinical development or regulatory approval, page 56. The reliance on third-party manufacturers and collaborators also poses risks, as their ability to perform their obligations may be compromised, page 57. Furthermore, there are concerns about inventory buildup or supply chain disruption due to rising demand for APIs, which may lead to increased competition and limited capacity, page 58. Single-source suppliers may not remain in business or be purchased by competitors, exacerbating the issue. The company's inability to successfully integrate or develop a distribution channel for acquired product lines is also a concern, page 80. Global markets may experience additional disruptions due to ongoing conflicts in the Middle East, which could negatively impact their cost of materials and production processes, page 83. Delays or issues with preclinical studies, clinical trials, or regulatory challenges can further complicate supply chain management, page 100. That concludes the financial summary for Amylyx Pharmaceuticals Inc. Feel free to comment below, and I will be happy to answer them when possible.